We're going to discuss a Dave Ramsey advice piece that I saw in the newspaper. It goes against some of the things that we have talked about on this podcast, and I'm talking about house hacking.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 51. So happy New Year to everyone out there. And for our New Year episode, our first episode in 2017, I thought I'd do something a little bit different. I've invited back two of my previous guests, Justin Workman, who was episode 3, and Rob Minch, who was episode 9. We're going to discuss something that I saw in the newspaper a couple months ago, and it really struck me. And I'm talking about a Dave Ramsey advice piece that I saw in the newspaper. Dave Ramsey is basically a financial guru. He has an advice column in the paper. He's written many books, and he's very respected as a financial columnist and guru. He wrote something that I wanted to put out there because it goes against some of the things that we have talked about on this podcast, and I'm talking about house hacking. But let me read this to you. This is out of Dave Ramsey's advice column. And someone wrote in and said, "Dear Dave, I've been out of college for a few years and I have no debt. I'd like to start investing, so I'm thinking about buying a triplex, living in one of the apartments and renting the other two. Should I get an interest-only loan for this? Chad." And Dave responds, "Dear Chad, never ever get an interest-only loan. If you can't make this idea happen on a 15-year fixed-rate mortgage that takes no more than 25% of your take-home pay, then you can't afford this project." And then Dave goes on to say, "Think about this too. If you buy a complex and live on the property, you'll have to set down and enforce some strict renters guidelines. Living with renters can be tricky because they'll have access to you 24 hours a day, and some of them will abuse the privilege. Then again, you'll have that kind of access to them as well. Not exactly a bad thing when you have people living in a complex you own. Here's an option. What if you just bought a nice, inexpensive single-family home for yourself? You wouldn't have the cash flow, but you will have the appreciation and a better chance of reselling down the road. Plus, if you want to invest further, there are always mutual funds. Real estate plans work out just like you want them to, only about half the time. Don't discount the risk and expense either. Dave." So, Justin Workman and Rob Minch, thanks for joining me today to discuss this advice from Dave Ramsey. I am not a Dave Ramsey expert. I've certainly heard enough of his advice to know that I don't follow it very well. But I think you two probably follow it much better than I do. And I'm really curious what your perspective is on this. And I'd like to kind of take it from the top. I mean, his first piece of advice has to do with getting an interest-only loan. And I'm wondering, Justin, we'll start with you, what you think about that part of the advice.
I think it's great advice on the interest-only loan because it opens yourself up to an additional risk, unlike a normally amortized loan. Without paying down that principal, you're never gaining equity. And the issue is you're going to eventually have to refinance that at some point in time. And depending on what the value has done, you could really end up in a world of hurt because you haven't paid down any principal. You still owe the exact same amount of money on the loan as what you bought it for originally. So I think you can get into a lot of trouble heading down the interest-only route.
Rob, what about you?
I would say I would be more comfortable personally with a 30-year amortization. So you are, at least paying some of it down. Now, obviously, you've got to take in consideration the appreciation of the property. But just being conservative, I would think that a 30-year would be fine. I don't know that I would be very comfortable with an interest only. I know that, obviously a lot of people do it and it creates more cash flow, but I just personally a little more conservative.
Yeah, and the amortization, by the way, for those who are wondering, a 15-year amortized loan is basically a loan that is paid off over a period of 15 years. So you're paying the interest and the principal down over a 15-year period, and that increases your monthly payment each year. A 30-year amortized loan, which you're more comfortable with, Rob, that spreads it out over a 30-year period. So over a 30-year period, you are paying down interest and principal during that period. The monthly cost of paying that down is a lot less. So that increases your cash flow, but it takes a lot longer to pay it off in full. And in the meantime, you're paying a lot more in interest on that loan because you're spreading it out over such a long period. And I think Dave's advice is sound for people who want to be free and clear and own their properties free and clear in a much quicker time period.
And I think that's one thing that Dave does really well is his whole philosophy is about getting people out of debt. And that interest only does not help his cause at all because you're still carrying the same amount of debt for the length of the loan. You're not getting out of debt. So I think that's part of his response in that.
I think we can all agree that Dave's advice about the interest-only loan is pretty sound. Rob, you and I would prefer a 30-year fixed rate so we can decrease our monthly expenses and increase our cash flow. The idea of getting an interest-only loan, it seems like we have a consensus that we would agree with Dave on that point. Now, here's where I disagree with Dave, because the writer is really saying, I want to buy a 3-unit. And I want to live in one of the units and rent out the other 2 and have the income that I receive from those 2 units pay the mortgage and a lot of my expenses and maybe put some money in my pocket at the end of the month. Now, if you are a listener to this podcast, you know that I've talked to numerous people who have done just that, mostly with duplexes or student housing. But that house hacking way of building wealth and getting into real estate, I think, is one of the best ways for anyone, especially younger people, to get involved in real estate investing. So when Dave advises against doing that and getting a single family house instead, because you'll get more appreciation, I don't know if I agree with that part. So Rob, we'll start with you this time. Rob Minch, what do you think?
I don't agree with Dave in that regard. Personally, the first home I ever purchased was a 4-unit, and I did live in it. It was a big learning curve and but a very good experience in which I've done very well through the years. And I embrace the philosophy of if you can make the sacrifice at first, I think it's a good thing. Yeah, I mean, it's nice to have residents that essentially pay for your payment and then, put a couple bucks in your pocket. And you learn a lot along the way.
Yeah, Justin, what do you think about Dave's advice?
I love the idea of the house hacking, as Bigger Pockets call it, or like you say, living in a unit and renting out the others and creating that cash flow, creating that principal pay down. I think that philosophy or that mindset is a great thing. I was really surprised that he kind of strayed away from the real estate investing side because he is a very big real estate investor, and a lot of people don't know that. He always preaches the mutual funds and that kind of investment mentality, but he invests heavily in real estate. So I was surprised that he headed that direction. I think he gave some good advice of it is scary to be living with some of your tenants because of the availability. But that's something that can be managed, and with a little instruction on your tenant's part, I don't think it would be that difficult to maintain.
Yeah, it seems like if you take it seriously, if you're going to do the house hacking and live in one of the units, rent out the other 2, if you take it seriously and you're willing to take the extra step to educate yourself on how to take it seriously, how to have good background checks and credit checks and leases and guidelines for your residents, then I think you're fit to do exactly what this writer or this person is writing into Dave about. And there are groups, and this is a good plug for the RPOA. There are groups like the Rental Property Owners Association or the local RIA where you can get access to that kind of information and that kind of education. So I think if you're out there listening to this and that's something you're interested in, you have plenty of local resources where you can go to help you do such a thing. Who is this advice really meant for when Dave says don't buy a 3-unit, buy a single-family home instead.
Yeah, I guess I don't know who Dave's trying to pitch this to. He's talking to a younger guy that's in his 20s, out of college. He hasn't settled down yet. He's not married. You don't know where he's coming from as far as stage of life. So maybe he's looking at it from that perspective of, you may see some significant life changes in the next few years. You may not want this thing holding you back at some point in time. But I think it's a great opportunity, especially for somebody just starting out that wants to invest. It's a great way to get them in, relatively safe and affordable, especially when you look at the financing terms that are available for them. As an owner-occupied dwelling, I think it's a good opportunity to jump in.
Rob, would you agree? I mean, is this...
I totally agree. That's who I was. Exactly who Justin just described. That's who I was, and that's what I did.
Yeah, and this writer, Chad, he says he's been out of college for a few years and he has no debt. So he sounds like a pretty responsible person who would be more than well-equipped to handle renting out the 2 units next door to him. Let's look at it from Dave's perspective. Managing tenants who live next door to you could be a problem. And Rob, you did just that. You lived in a 4-unit, and so you had 3 other units that you were renting out. What kind of problems did you have?
It was just the learning curve. I really had no experience in regards to dealing with tenants or dealing with leases or, dealing with any of the things that I need to qualify, proper residents. So the best advice that I got was to go to the RPOA and actually get all those resources, and that's exactly what I did, and it was very beneficial.
I know we talked about this during your episode, which is episode 9 for people who want to go back and listen to Rob Minch. But you did have some issues with some of your tenants while you were living there.
A particular resident that comes to mind, there was one that was drunk and quite combative and, wanted to get into his apartment late at night and had woken me up. And that was a big learning experience, and I never got another one like that. But you make mistakes along the way. You learn. Mm-hmm.
Now, is that someone that you didn't qualify properly?
I did.
Or what happened?
I did qualify him properly, but you can't always anticipate people's behavior. Regardless, and obviously, when you do live on premises, they've got full access to you.
So, was it just awkward for you to have to live next to this guy after that incident, or did you get rid of him pretty quickly?
Yeah, I got rid of him as quickly as I legally could.
Mm-hmm. Okay. Did you ever fear for your safety?
No, I feared for his safety.
Okay. Good.
Yeah, and I'd agree. I think that would be the struggle for me, although I've never been in that situation. But you end up with similar situations where you're going through an eviction and that tenant is on your last nerve, but they're calling for little miscellaneous maintenance requests all the time, or they're just constantly bugging you, or they just want to speak to you and talk about things, and you go and see them and you're already annoyed with them. So to see them on a daily basis just coming and going out of your building, I could see would be extremely frustrating for a lot of people, because he's costing you money. I'm sure you're going to end up in court with him. You're probably very nervous about the whole situation. What can you do, can't you do? So I can understand from that perspective, it would be difficult to manage some of the tenants.
There are some downsides. I think Dave's advice can be warranted in some situations, but there are ways to avoid that. And let's talk about the upside of doing what this writer Chad wants to do, which is buy a 3-unit, live in one of the units, and collect rent from the other 2. What are the upsides you see, Rob?
Cash flow. I mean, the fact that not only are you getting an appreciating asset, you're creating cash flow, obviously, as long as you've done your numbers correctly, and you're going to be able to make your payment. You're going to put a couple bucks in your pocket, and your property is appreciating. That's very beneficial.
Yeah, and you are earning from all of those sides. You do get your monthly cash flow from your income. You're getting your depreciation expenses on the other 2/3 of the building in that case. You're getting your principal pay down. There's a lot of advantages to doing the house hacking that are extremely beneficial to somebody that's starting out.
Yeah, I think just the idea of having, and you should be able to achieve this with a 3-unit. I know I've certainly talked to people who have achieved it with a duplex. Just the idea of having your tenants pay your mortgage and hopefully paying your property tax, paying your insurance costs. The income you're receiving from them is more than paying for that. That idea of almost living for free in your own property, that's a very strong incentive to me to do what this writer Chad wants to do. And then the flip side of that coin is now you're living essentially for free. Maybe you're making some cash flow. I know I've talked to some people who've been doing just that, putting a couple $100s in their pocket each month. That's money you have to go spend elsewhere now. I mean, and it's a repeatable process. If you really want to repeat it, you can do that for a year and then buy another 3-unit or a 2-unit or a 4-unit or whatever, live in it, live in that one and repeat the process.
It's a viable strategy.
And then you're creating all these rental properties that will continue to generate income for you for the long term.
Yeah, and especially if you would follow a part of Dave's philosophy anyway of keeping it on a 15-year fixed, keeping your expenses down, 25% down payment, some of that type of stuff. If you would save what your normal mortgage payment would be every month as you're living there, plus the income from that property, you will generate a lot of cash in a short period of time where it will enable you to go out and buy another one because you'll have that cash for the down payment since you've saved that money along the way. It's a great strategy for early growth, there's no doubt.
Yeah. So let's early growth because we've all talked to people who want to get into real estate investing. Personally, I see this as one of the best ways to get into real estate investing is to do this house hacking. Do what this writer or reader Chad has suggested to Dave. What other ways do you guys see as being a good way to get into real estate investing?
Same thing. I think for me personally, buying distressed properties, buying stuff that needs a ton of work, I think is extremely beneficial. If you're willing to put that sweat equity into it, if you're willing to handle the rehab, your growth potential is huge because you can buy something and put some money with it, and you have a property that's much higher in value, and your rents will exceed what they would have otherwise. Your return on investment, I guess, will be substantially more than if you bought a turnkey property.
So you're taking it to another level. Now there's a whole new level of involvement with what you just said, which is getting into the rehab portion. What do you think Dave Ramsey would say about that?
Dave's talked about it before. His big thing is if you have the cash to do it, go ahead. Same thing with people that have called in and wanted to flip properties.
If you have the cash. So is he saying do it all cash? Don't borrow money. Just if you have the cash, your own cash, then give it a shot. Huh?
Yeah, and that falls in line with his philosophy of being debt free. His philosophy fears risk. There's a big risk with doing things with leverage, with debt. Especially if you're trying to flip something and it doesn't sell. If you're trying to rehab a property and you can't get to the finish line or you run out of money because you didn't budget correctly. There's a big risk where you could lose some money, a substantial amount possibly. So by limiting the risk of the debt, it helps the process along. And enables you to make more on the back end because you're not paying that interest payment.
Rob, what about you? Now, do you agree with Justin about doing it with your own cash, or would you use leverage, other people's money?
First of all, you've got to look at your numbers and look at what the asset could be worth. What are we talking about a single family? Are we talking about a multi-unit? What could it possibly rent for? What could it sell for? It totally depends on the strategy, but I look at the numbers, and that's what I'm comfortable with, and as long as I'm very conservative with my numbers, I wouldn't be opposed to taking on debt to do it as long as, you've done your math very well.
We've had this conversation about debt, and it usually comes down to our comfort level as to whether or not we're willing to use leverage. Justin, I know you're much more in the Dave Ramsey camp.
Yep.
Leverage is a sin.
The borrower is slave to the lender.
This is where I want to bring up the rich dad Robert Kiyosaki philosophy, which is what I follow. And again, I'm no expert on Robert Kiyosaki and Rich Dad, but I do like to think that my thought process is more in line with his, which is using smart leverage. If we can borrow money at such low interest rates right now, and we can extend that money out with a 30-year amortization and lower our monthly payments, increase our cash flow, we can build wealth a lot faster. And that's the process that I've been following for the past 15 years, is just using smart leverage. Not only using smart leverage to acquire properties quickly, but I've also gotten into using other people's money, so bringing in other investors into my deals as well. Unlike you guys, you guys are the owners of your properties. And in a lot of cases, you own your properties free and clear. With the properties that I own, I have many investors. Some I have a lot of investors in some of the properties, and I'm using leverage as much as I possibly can. All the way up to 75 to 80% loan to value on some of the larger apartment communities. And using that leverage is what allows me to basically take these kind of deals down. We purchased an apartment community that was $7.6 million. You almost have to use debt to be able to do it. And this is one of the reasons why I invited you both here today, because I know that we sort of differ in our philosophies. You are both very smart, successful Dave Ramsey type investors. I'm more of the Robert Kiyosaki, Rich Dad perspective. And I just wanted to get your perspective on what I just said.
There's not always a clear problem to what you're doing. I think what you have to do is look at the history, look at your personal experiences. I know just from my background, I knew a lot of guys in the last downturn that lost everything. I mean, not just their investment property, but their personal residence. I mean, and some of these guys were in their 70s. I mean, they had done extremely well over the course of their life. But they ran into issues with the commercial lending side, was part of it, and the price of housing, because they both dropped significantly. And with a commercial note, most of the time you need to refinance them every 5 years. So what happened is, say they refinanced the first time in 2004, at 5 years later in 2009, we were on a downward spiral. The banks were extremely afraid of lending them money at that point in time. They had a difficult time valuing properties and assets. So a lot of times they could not get or acquire a new loan for some of the properties. In addition, a lot of them had other businesses that had slowed, so their cash flow was not as good from their personal side. And these were guys that had millions of dollars in assets that have now nothing. I mean, I know one guy that lives in government-assisted a retirement community at this point. So I think that becomes the issue is today everything looks great. We all see roses. We're at extremely low interest rates. And I think that's something that we really need to key on is, from a risk standpoint, our interest rates have been so low for so long. We're nowhere near our historical averages. Even if you look at 2007 and 8, our interest rates on a 30-year fixed were more like 6.5%. Today we're at under 4, 3 3/4, somewhere in that ballpark. So again, as those interest rates rise, it does multiple things to the value of properties. The biggest thing that hurts the single family market is it changes the affordability, because interest rates could go from 4 to 7%, which may not sound like a huge deal, but people's wages are not going to move up that same percentage. So today they may be able to afford, we'll take an average income of $50,000. You break that down after taxes, they get about $3,000 a month. They can afford a little over a $200,000 house, $210,000 house on a 30-year fixed mortgage at 4%. If you take that up a notch in, say, 5 years, interest rates are at 7%. That same person making $50,000 will only be able to afford a $150,000 house based on that percentage in interest increase. So that's where it gets really scary, is because home values will drop because the affordability of them has gone away just because the interest rates have gone up so much. And I think that's one thing you see a lot of now is people bundling all these houses together in a commercial loan just so they can get more loans. So they've tapped out between 4 and 10, depending on their bank, with the traditional Fannie Mae, Freddie Mac loans. So they go to the commercial side. They bundle 3, 4, 5, 6 houses together and do a commercial loan. With those commercial loans comes that risk of the refinance every 5 years. So what happens when today they're worth $200,000 a house, you put 5 of them in, you got $1 million in assets. 5 years from now, interest rates go to 7%. You've lost over $50,000 a house. Now all of a sudden you're at about a 70% equity position, even though you put 25% down. The banks are really going to question whether they want to refinance you at that point. And that's when it gets really scary.
That's when it gets tricky. Yeah,
It is.
You've made a lot of excellent points there. I'm going to shoot them down one by one.
That's just fine. I'm good with that.
No, those are excellent points, and I agree. I agree with everything you're saying.
It's just a risk mentality. It really is. And
so let's talk about that risk mentality, because yes. So just to kind of clarify or expand on something you just said, the 5-year balloon.
Yeah.
When you buy a residential property, which is 1 to 4 units,
yes,
you can usually get fixed financing for 15 to 30 years, which means you're locked in for 15 years, 30 years. And your rate's not, if it's a fixed rate, it's not going anywhere. Yeah. But once you're in the commercial world, which is 5 units or more, now you're dealing with commercial lending, and there really I don't know if you can even get 30-year amortization, but it's usually going to have a balloon payment, which comes due a lot of times in 5 years, sometimes in 10 years, and occasionally I've seen it a 15-year balloon. The longer you can extend out that period of ownership before that balloon, and then when that balloon, what that basically means is that's when your loan comes due. So it might be amortized for 30 years, but it's going to come due in 5 years. That is a tricky situation, and you're right, because from where we sit right now, which is we're recording this December of 2016. It's going to air January of 2017. Interest rates are creeping up. But they're still at an all-time low. If you look out 5 years, you're absolutely right. The interest rates will probably be a lot higher. Now, I've been saying that every year for the past 15 years, literally, and they've done nothing but just gone down.
Continue to come down. Yeah.
But we can say with some confidence that in 5 years, the interest rates will be a lot higher than they are now. So if a balloon comes due on a commercial property, well, yeah, you're going to be stuck in a position where you're refinancing something, and maybe it's not worth what
you have into it
or what you're expecting, and that's a complication. Now, here's my answer to that, because I do give a lot of consideration to that in my investing.
As you have to.
As I have to, because you have to consider these things. Where is your property going to be in when the balloon comes due? Because that's all part of the exit strategy. So what I try to do with the larger commercial properties that I'm investing in is get that 10-year balloon. First of all, I want that 10-year balloon, because over a 10-year period, things are going to even themselves out a lot more. You're absolutely right. During the recession, a lot of loans came due, and the values had dropped so much that people they got slaughtered.
Yeah, they could not refinance in any way, shape, or form.
A lot of that also had to do with just the availability of money too. Banks were very reluctant to lend during that period. In fact, they were so reluctant and scared to lend that a lot of times they ended up shooting themselves in the foot, because I think the banks lost just as much during that period because of the stupid decisions they made.
Unquestionably.
And I know I benefited from some of those stupid decisions because I was able to pick some properties up.
Yep.
Yeah.
No question.
Yeah.
And I think they slowly learned through the process as well, because you would see guys that had notes come due in like 2013, 2012, and they were much more willing to work with them on trying to create a means out rather than just taking it from them. Where I think early on they had a very hard-nosed stance of, this is due, either pay it or we're going to take it back, because they had no idea what was to come.
Yeah. And they were also responding to the government, too, which
They
I think
were.
was putting some pretty heavy pressure on them to clean up their books, which created great opportunities for investors who had cash and could go in and buy these properties for pennies on the dollar. Do we see that happening again? And if it does, how do we protect ourselves from that?
I don't see it happening again, and especially not to that degree whatsoever. And I feel like you can protect yourself by, doing your numbers and, looking at everything. Obviously, if you are getting a commercial loan, if it, has got a 5-year balloon or a 10-year balloon, you really got to, look at that and see where you believe the market's going to be, what your property's going to be worth, what your equity stake is going to be, so that you're in the position to, hold the power, and either you're going to sell it or you're going to retain it and get a new loan. And it's all just about, doing your numbers and projecting out and being very precise.
I think, like you said, there's advantages with a 10-year balloon because historically we have a 10-year market cycle, essentially, in the real estate market. So you see those up and down swings, those minor changes. This one was obviously worse than the previous cycles. But I think we will see some changes coming. I think that's always going to happen. We're always going to see changes. I guess I'm always more hesitant to say, yes, we're never going to see this again. Things are always going to be better because part of me doesn't believe it, You look back at the 80s or 90s, they still had these issues, and they handled them in different ways. Through the 80s, they were 10+% interest rates, which really drove down the market as far as price goes, because it changed that affordability aspect of what people could afford. Same thing, you had different dips through the 90s, early 2000s, again 2008. I think you'll continue to see these ups and downs as the market goes. It's just the normal ebb and flow of the economy and the world economy. Especially if you throw a war into things, it really messes with the whole cycle and the market cycles and the world economies.
I want to touch on the affordability because once interest rates do go up, I think the affordability factor will come into play quite heavily for residential housing.
Yes.
But housing that people buy to live in for themselves. I do think that will help apartment rentals. And here's why, and especially the B and C apartment rentals that are more affordable, not the A-class stuff that's brand new that has super high rents, but the B and C properties that's already in existence. They're in good shape, but they're at a rent where more people can afford them. That's where, if that affordability problem that you mentioned comes into play with higher interest rates, you're going to find a lot more renters going to the apartments and the rent, and not just apartments, but any type of rental property.
Yeah.
They'll have no choice.
Yeah, exactly. Initially, they won't have a choice. As the market corrects itself and as prices drop, they'll have some choices again. They'll have some other opportunities. But with that, the rent's going to fluctuate as well. Even mid to late 2000s, during the crash, after the crash, vacancy numbers were extremely high. Rents actually decreased for about a 2-year period, 1.5 year period, rather than go up. So I think you run into that issue as well. And I guess with the apartment investing, as long as we're on the topic, you invest based on a cap rate. So say you buy at a 10% cap rate today and you're paying 4% interest, you got a 6% spread. As that rate goes up from a 4 to a 7, now you only have a 3% spread. So your actual gains on that property are going to diminish. And depending on what vacancy does and what rates do, that 10 cap may not stay the same. That could actually go down slightly if we do have high vacancies again, if we do have lower rents. It could create some real problems again, even on the commercial side. Now, I do agree that as affordability changes and comes into play, more people are going to go to the rental market. But even today, I mean, things for essentially the middle class are more affordable than ever because interest rates are so low. They should have that extra money around. Car interest rates are between 0 and 2%. So they don't have as much out-of-pocket money every month going out where they should be able to buy. They should be able to rent well today. where when interest rates go up, it affects their monthly cash flow differently. Because when their car rate goes up and they buy a new car, it's going to take more of a hit out of their wallet. So their affordability will go down as well on what they can afford to pay for rent and what they can afford to pay to buy a house.
Do you think that as interest rates go up, though, you're going to see inflation, and you're going to see, so as interest rates go up, I've heard a lot of people say, so too will rents, because things across the board will just get more expensive. Are you saying that the affordability factor will actually push the rents back down?
In my mind, a little bit, because like you say, rent is not their only expense. Most of these people are paying interest on car loans, are paying interest on student loans. As those rates go up as well, that affects their monthly budget, the money they have to spend on rent, on eating, living, and that type of thing. So if we do see the inflation, that means that their paycheck has gone up to cover and compensate for that. And it's hard to say, They say we've had no inflation for the past how many years, but the price of bread and milk and everything else has gone up, dollars 50% or better. So it's hard to justify where is that true inflation cost at, and how does it really affect the market and people's perspective on it.
And there's another component to it too, because we're talking about the economic cycles, inflation and interest rates, but there's the population cycle as well.
Yep.
And if you look at the demographics, they're very, very strong for increased rental housing, because you've got the baby boomers, which are 75 million. You've got the millennials, which are right around that amount, 70, I think even bigger, 76, 77 million. And you've got the immigrant population too, which is predicted to be growing as well, which is going to create a huge demand on rental property. Even though there's a lot of new stuff coming online, there may not be enough existing stuff to meet that demand, which could in turn push up rental rates.
And I think that's very true for the short term. There's not enough.
You always have.
I'm always going to be pessimistic and shoot you down. Yeah. I think it's very true for the short term, but we can look at examples of Florida, Arizona, where they had a need for housing and they overbuilt.
Yeah.
They were producing so much product that they just completely overbuilt and overshot it, and at the end of the day, nobody bought. And we could definitely walk into that situation again too. It's part of that risk with investing. You never know truly what's going to happen at the end of the day. It's a mixed bag, but you've got to, be very conservative in your numbers and what you do in your projections, and hope for the best some days. Yeah, I just got to keep shooting you down for fun.
I know. That's why I like having you around.
Yeah. Yeah.
I mean, I'm conservative, but damn.
I know. It's awful. Yeah. That's why cash is king. I wait for all you guys to buy stuff and lose it through the foreclosure in the next downturn, and I'll swoop it up again. So I'm ready.
well, let's talk about that. I mean, what do we see on the horizon? I mean, people listening to this, there's a lot of people who are very excited about investing in real estate in 2017. I know I've kind of been sitting on the fence for a while, although I'm starting to look at some other properties. I'm starting to see some things that might make sense to me. What's your outlook, Rob? What do you see in 2017?
It depends on the interest rates. It depends on, what's available. I mean, at the end of the day, I'm going to beat a dead horse. It's all about the deal, that you're specifically looking at, and, your numbers and where it's going to be in the next 5 to 10 years. And you've really got to be able to analyze that and, put it in a place that you're comfortable with if you're going to move forward.
Are you willing to overpay for something today that you can anticipate will be worth a lot more in the next 5 years?
Not me personally, no.
What about you, Justin? What do you see coming up in the next 5 years? Where are you in your investing mindset?
Yeah, I'm still picking stuff up. There's no doubt about that. But it was Warren Buffett that said, be greedy when everyone is fearful, and be fearful when everyone is greedy. Right now, real estate is such a hot topic. Everybody wants it. Everybody wants to get in. You've got to be fearful at this point, because everybody can buy again. This summer, we sold a house to a couple where their best credit score was a 590. I mean, we are back in that 2007, 2008 mode of you just need a pulse and can sign a document to get a mortgage.
Oh, so you're seeing the restrictions.
The restrictions have been
being
lifted.
Mm-hmm.
Yeah,
I've noticed a numerous amount of companies that are out there that are selling subprime mortgages, and it is very scary to look at, quite frankly.
Well, and they've introduced new products too, where it used to be you had to do an FHA type of a loan to get a 3% down loan, and that could be your down payment could have been paid for by the seller. Now they've opened up new products. They call them conventional loans that basically have the same terms. Where in the past, a conventional loan required that 20% down to be qualified as conventional. So they're manipulating things a little bit on that end, from what I see, that I'm not overly fond of. Where I'm afraid we may walk ourselves back down into that rabbit hole. Right now, I feel like the banks have a lot of money to lend, and they have no one to lend it to. Over the past few years, everybody's gone through and has done their refinancing, has moved up in house, has rebought. So we're kind of absorbed the majority of that need. So now they're kind of creating some products that do come with some more risk just so that they can move some money. Because that's how they make it. They've got to sell product.
And where you see on the residential lending side, you're seeing some loosening of restrictions. On the commercial side, I think there's still a lot of oversight and compliance going on with the commercial lenders to make sure that they're putting their money out there in properties that are going to succeed. And they do a lot of underwriting, annual inspections to make sure that you're taking care of the property. They're forcing capital reserve accounts, probably more than is necessary, but they're being very cautious still. And I think that what I'm hoping is that bodes well for the commercial lending world and the commercial apartments that I'm investing in.
And I totally agree. I've talked to numerous commercial lenders, and they're very sound in their underwriting.
Yeah, where they may not have been 10 years ago.
Absolutely.
Well, and they're covering their risk now too. Because in the past, like you said, they didn't have capital improvements reserves that they required you to have. They just assumed you were going to take care of the building. Now they've got that extra cash on hand to know that it's going to be taken care of. Or worst case scenario, if they get it back, they have the money to fix it and make it a viable product again. So they're managing their risk accordingly. They got burned, and they're learning from it a little bit.
They've learned their lesson, I would say.
Yeah, I hope so. Well, I don't know. I hope so. I mean, I know in my case, they've certainly, the commercial loans that I have out there are very, very well maintained by the lender. They want to make sure that we're taking good care of the property, which luckily we are. But they're there to make sure that we are. Final question here, and I want to go back to Dave's last comment here in his advice. He says real estate plans work out just like you want them to, only about half the time. Don't discount the risk and expense either. Rob, what's your success rate with the real estate that you've bought? Would you say that only half of them have worked out, or?
There have been deals where I've only made a couple $1,000s, and there have been deals where I've done well. You learn along the way, depending on where you're at in your career, and you know how to look at a deal better, and you analyze it, and if it makes sense, go for it.
What about you, Justin? What's your percent win ratio?
Oh, they're all wins. It's just a matter of if it's for your own benefit, your own paid for education, or if it's a financial benefit.
So even if you lose money, it can still be a win.
It's still a win because you learn from it. You know what to avoid and to watch for. I think what he's advising in the letter is, a lot of people, when they look at rental properties, is they never account for all of the expenses. They look at a house, I'm going to buy a house and I can get $1,000 a month for rent. So they think at the end of the year, they ended up with $12,000 in rent. They'd never consider the insurance, the property taxes,
the increase in property taxes.
Yeah, and a yearly increase, that yearly federal minimum, or the jump upon the sale of the property, depending on what the situation is. The capital improvements, I think, is a big one that nobody touches on when they first get started. They never account that they need to put, $1,000 away every year, or whatever it may be, to cover the hot water heater, the furnace, the roof, the windows, the doors, the siding. They just jump in and think, oh, well, I'm getting paid $12,000 a year to buy this thing. I paid $120,000. Well, it's a 10% return on capital, and they never factor in those additional expenses. And I think that's really what he's trying to get into a little bit. I guess that's what I'm trying to read into, is there's more to it than just the amount you pay for it and the amount that you can get in rent. It really comes down to running your numbers and knowing your numbers and learning how to understand them. A lot of guys use the 50% rule of half your rent's going to go towards, CapEx and insurance taxes, that kind of thing, to ballpark some properties. But you've really got to break that down on them before you buy. I think that is the key, is the numbers tell the true story, and be conservative. It's hard to do when you're excited about it. You just want to jump into things. Oh, this is only going to cost me, $50 a month for insurance because that's around what my house cost me. You've got to make the calls. You've got to look into it, and you really need to dive into the numbers heavily, because
Before
that's where
you buy.
Most people get in trouble. Yeah.
The rules of thumb are great.
Yeah.
And I use them all the time, but once you get past that rule of thumb, that's just the surface. You got to dig a lot deeper to know if you're getting into a good situation. I agree with what you just said, Justin. They're all wins. Even if I lose money, I'm selling my last property, out-of-state property in North Carolina today, and I'm losing money. I had to bring money to the closing table. But you know what? It led to the next investment and the next investment. And now, I've got a pretty long string of successes after some of those failures in the beginning. But I think they're all successes as long as, even if you lose money, you learn from that and you're able to move on and continue, rather than just quit. And I think maybe some people might invest in their first property, lose a lot of money, and say, oh, I did that once, it doesn't work. Well, it didn't work for you, and obviously you didn't learn from the lesson how to do it right the next time, because sometimes those expensive failures can lead to some pretty huge successes.
And I guess to piggyback on that a little bit is you don't have to just make all your own mistakes. I mean, listening to this podcast, reading what other people have done and written about is huge. There's plenty of that out there, and you're going to repeat some of those mistakes, but educate yourself as much as possible. I mean, every time you're in your car driving, turn on a podcast, turn on a book. There's times throughout the day where you can continually educate yourself.
Now more than ever, there's a lot of access to listening to people who are willing to share their experiences. And I think podcasts are just revolutionary because of that.
Yeah.
Not just this one.
No, but this is the best.
We all listen to it.
Yeah.
Thank you.
Yeah.
You finally said something I agree with.
Yeah. No, but in addition to that too is tie into your local groups, your RIAs, your meetup groups, whatever's out there. You don't meet too many people out there that aren't going to share with you some information or some knowledge. Even if you've never done it before, there's going to be a lot of people just like you out there. Get to know them, figure out what they've learned, find out what mistakes they've made. Have somebody experienced run through things with you. You got to figure out who you can and can't trust a little bit. You don't want them to steal your deal, but you can work through that. And a lot of people are more than willing to help out because they've asked for help in the past, and it pays off. So.
Yeah, it really is an industry where working with other people and sharing with other people just has huge benefits.
The mistakes that other people have made are much cheaper.
Yeah, that's for sure. That is for sure.
That's right. And more fun to talk about and listen about.
Absolutely.
Yeah, well, Rob Minch and Justin Workman, I want to thank you for taking the time to kind of dissect Dave Ramsey and his advice, and kind of take the conversation into some unexpected directions. And I want to thank Dave Ramsey for giving us something to talk about and think about. I hope Chad bought that 3-unit and is now happily living in one of them and pocketing the cash flow every month. I certainly would have advised him to do so.
I only hope that he bought on the 15-year note, non-interest only, fully ammed, 25% down. I don't want to see him in the 3-unit with the interest only.
Definitely. Yeah, we all agree with Dave on that.
Absolutely.
Yeah, I think Rob and I would prefer to see him with a 30-year amortization.
I mean, here's the thing, Justin. He can always set up his own amortization, and if he's got the extra cash flow, he can actually make his own amortization to that 15-year if he would like. It's just I like the flexibility of the 30-year.
There you go. 30-year gives you a lower monthly payment, but you can always pay it down faster.
You always have the option.
All right. Well, let's end on that advice. Happy New Year, everybody. Rob, Justin, thanks so much.
Thank you.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.